what about these bonds, the Euro higher bonds enterprise? What is any like positive or negative signal of these companies? And do you have like these companies? Do you have any like investment recommendations?
So, we invest out of all European denominated securities, corporate securities with a BBB minus and lower. We have a fairly thorough process that we follow, and we have analysts in California, analysts in London, Singapore, so it's a reasonable large team, and we meet management both in New York, both in San Francisco, San Mateo, and London. I meet myself a lot of management teams, and our investment process is quite thorough, and we follow strict guidelines before investing.
What is the guidelines then?
Guidelines in terms of if we believe really the story is suited for our funds, and if you think that the capital structure is the right one, and firstly, when you look at a corporate, you first of all you need to like the business, and second of all you need to think that the capital structure is the right one, because sometimes you may have a good business but too much leverage, and they will default.
And what if this company at the beginning is really good capital structure, but maybe after like 5 years has some problem? How you?
Yeah, I mean obviously things change. The life of a UL bond is quite short anyway. They don't tend to stay in the market more than 3, 4, 5 years, although the maturity normally is 7 years. But they tend to be called before that. But obviously things cannot go as you have originally thought. There are a number of things you could do. From the basic one is you eventually try to sell at a loss, because if it has not done well, then obviously you want to sell at a loss. Otherwise, you may try to reach an agreement with the shareholders and eventually restructure the capital structure.
Do you shorten the duration of the bond?
Yes.
So that you don't have to suffer?
Yes, I mean duration I wouldn't say it's an issue for the euro market. I think the big issues are more in terms of total leverage in the system within the region, lack of we have lack of deleveraging during the past few years, particularly government sovereign have increased their leverage compared to the GDP, and financials have started to decrease leveraging. Consumer has increased a little bit its leverage. So I think leverage is still too high in the system, so it has to come down. So that's the key risk. And the other risk is probably political risk, as we mentioned at the beginning. And then obviously it's an old continent, and we suffer some of the issues that Japan has as well. So we need to get out, and that's the reason why ECB and Bank of Japan are big into expansion. We have to see whether they'll be successful.
Okay, so higher bonds in Europe, the returns is much better than the US ones. Maybe it's due to the region that shows signs of economic recovery recently. But
no, I don't think so. It's more due to because US growth is growing even more than European growth. This is the U.S. shale market has been suffering particular exposure to the energy. And metals and mining. And there is a larger components, more than 20%.
But it's good for Europe, right? Because it imports the oil.
Yeah.
And
what is good for Europe is not very good for U.S. Yes.
Okay. How long will this situation last? Like Europe higher bonds?
I think obviously the U.S. shale market it's more attractive from a yield perspective, but has more risk and default expectations are higher in the U.S. It very much depends on the investor what he thinks about the outlook in terms of oil price. I mean, if you think oil prices will go up from here quite sharply, then probably U.S. yield is a better place. If you think that the energy prices, metal minings will stay where they are or lower for longer, is what they're telling us, then I think euro yield is equally good. I mean, as a firm, we have a positive view also on U.S. yield. Obviously, this year has not done well. Euro yield has done much better. But at least you are compensated for it because the yield in U.S. it's quite attractive. It's much higher than in Europe, above 8%, and so I guess some investors would be looking at it now. That has held off as much as we have seen during the past 3 months in August, September, October, and I mean October has recovered, but it's now coming down again in November.
You just mentioned that the default rate in the U.S. might be higher, but would it be even higher after the Fed raised the interest rate?
No, I don't think so. They're not. I don't think they are related. Obviously, if you think Fed funds to go up, very very sharply from here, it's not my job. I'm more on the corporate side. Then we might have an impact there. But no, I would say the default situation in the U.S. is very much due to to leverage and there was a higher triple C issuance in the past few years, not only energy, and there's been quite the language of the bonds, the way the covenants are written were very relaxed, so that won't help recovery rates for bondholders. So I wouldn't be concerned for the Fed for the time being. I would be more concerned about leverage within the U.S. companies and how they manage their capital structure in a different environment, especially the energy, but also other sectors as well. They've been impacted by some of them, and been impacted also by the weaker dollar, by the stronger dollar. So I think that the issue for U.S. yield is not interest rates, not at this stage.
Fitch warned in March that the credit market conditions of European high-yield bonds look very much like 2007. So what is your strategy in dealing with systemic risk that is similar to financial crisis?
But I would disagree a little bit with that. I think it's not like 2007. As I said at the beginning, the credit quality of the market has increased. So definitely the quality, the average quality of the market is higher compared to 2007. Obviously, there are some trends like leverage going up, a lot of euphoria, a lot of inflows. That doesn't help. So yeah, we have to be vigilant by no means. So as a matter of fact, that what I was saying before, that investors should not expect the historic performances, particularly the one posted in 2013, 2012. But they should be more realistic and should be thinking whether the coupon is enough for them. and they should take it from there. I think it's, the euro market has developed very much during the past 8 years. It's now a good alternative, valid to the US sale market. Before it was very small, and now it's independent, and so it has its own investor base. So we have to be vigilant, but I don't think we are in 2007. We have to monitor leverage up, but the quality of the market is a bit higher. Yeah.
Final question. Just comparing to other higher bonds, and what is the difference? Funds, yes. What is different with the?
Yeah, I think as a firm, as I said at the beginning, I think it's we are more of a global firm compared to some of my peers. And then obviously, some of my peers are very good as well. So I'm not saying that they are not. But we have a global approach. We have global presence. We meet corporates all over the world. Not myself, obviously. I am in London, but I do meet in London. Some of my colleagues meet in San Mateo, where we have most of the high yield team is based in San Mateo, it's in California. And then I would say the fund, it's probably the right size at the moment. It's not too big, it's not too small. It's around 930 million. I think it's a good starting point. And we are a little bit less. We have a beta that is a bit lower than the market in our peers. So our standard deviation is a bit lower than the market. So that probably is something that investors like. And so I would say that our key strength.
What is your any special strategies, investment strategy you want to tell our investors in the end, or any recommendations?
No, I mean I think I prefer not to give provide names. It's not part of our policy. I would say, as I said during this interview, the market has done well. We need to be realistic. But I think it's a safer instrument compared to the past. You mentioned junk bonds before, but it's a very much an expression of the past. It's true. I mean, they used to be called junk bonds, but the meaning is junk. I wouldn't call it junk bonds anymore. They are high bonds, euro bonds, or USA bonds.
A lot of fallen angels.
Yeah, there are more fallen angels. There are larger corporates. It's more diversified. So I think it's the strategy is to be take long-term views. Try to trade as less as possible because it's expensive. Bid-ask spread are quite wide. So take longer-term views and create a core backbone of the portfolio that generates the coupon, and then a smaller part that potentially can generate the capital gain.
Okay, thank you, Piero. Thank you very much for joining us today. We really appreciate.
Thank you for having me here.
Okay.